Hello, this is Mijun from Mijun University. Let's begin today's Majusi News for July 25th. Welcome to Mijun, where we continue to uphold the fundamentals of United States stock investing as always. Recently, the number of subscribers to the Mijun YouTube channel has increased a lot, and the number of clicks has also improved significantly compared to before. The video I uploaded yesterday is already getting almost 50,000 views. And one thing that I personally find really great is this. A lot of people are filling up the comment section, so every video is getting over 100 comments like this. Among them, I get to see words of encouragement, warm advice, and a wide variety of your opinions, thoughts, and messages. Personally, reading your comments is the most enjoyable time for me and has become the highlight of my day. Today as well, a lot of people have left comments, and I'd like to select a few of them to read to you and share my personal thoughts. The first comment I'll read is from a subscriber with the username Chamsinhan nickname. I have a question. I was lucky enough to discover the Mijun channel during the COVID period, which led me to start investing in United States stocks. You mentioned that Nvidia has gone up 15 times now, with a 1,000% compound return, and other stocks are also yielding returns like 300% and 500%. Thank you. But some people say that holding on to stocks for a long time is foolish and that you should sell some along the way. Since this is strictly my retirement fund, I'm not confident in buying and selling frequently. Is it okay to just keep holding on to them? I've also secured some cash based on the United States market, but I've only set it aside and haven't been able to put it to use. That's the question that was submitted. First of all, every time I see comments like this, I feel so proud. It makes me feel as happy as if I became rich myself. So it makes me think once again that the Mijun channel is actually helping a lot of people, even if just a little bit. Thank you for the great comment that makes me feel so happy. In my opinion, holding on to your stocks is not a problem. But as I've said many times, the stock market definitely has a beginning and an end, as I've mentioned before. So holding on to the stocks you're investing in means that when a new market cycle begins, as long as you're confident that the best choice you can make right now is still the same stock. Whether it's Nvidia, Tesla, Apple, or Google, there's no problem with holding on to the stocks you own. But you need to check them every day, every month. Is the stock I'm holding really the best choice? And I want to say that I hope you make your decisions based on the answer to this question. As you mentioned, you've secured a portion of your assets in cash. With sufficient cash, there's no need to sell stocks intentionally. Even if the stock price rises and then falls, you can buy more. So, there are only two reasons why I sell stocks. One is when my confidence in the stock drops. If my confidence in this stock decreases and after comparing it with other stocks, I find a better one, then I should sell the stock. Investment is a relative evaluation. You don't have to make money with just one stock. So if another stock looks better, you can sell your stock and move to the other one. That's the first point. The second point is when you don't have enough cash. If stocks go up too much, your cash ratio can drop much lower than you planned. At times like this, it's okay to sell some stocks. But if it's not for these two reasons, I want to say that you don't need to sell your stocks just because you've made a lot of profit. The second comment I'd like to introduce is a valuable message left by someone using the identification Kamjak Sangja. Hello, I've been subscribing and watching for a long time, but now I have a question. First, why don't you invest in Microsoft among the big tech and cloud companies like Amazon, Google, and Microsoft? And second, I like Apple devices, so I own Apple stock. With artificial intelligence development, new devices like smart glasses, subscription services expansion, and more. I'm asking what could drive Apple's stock price up and whether there's a possibility for the stock price to rise. Thank you for always providing great broadcasts, and I wish you continued success. You asked about two companies. First, I think you're curious about why I'm not investing in Microsoft. Second, you like Apple and asked about the outlook for Apple's stock. But honestly, I don't follow Apple that closely, so it's a bit difficult for me to give an overall evaluation of Apple's stock. However, one thing I do know is that I feel like Apple is falling far behind when it comes to artificial intelligence. Other companies are making huge investments and showing new innovations ahead of everyone else. Apple isn't doing that. That's why, for those reasons, I'm honestly not showing much interest in Apple stock. There's one thing I'd like to say here. When evaluating a stock, never use absolute evaluation. It's very important to use relative evaluation instead. That's what I believe. Right now, even in the United States stock market, there are actually well over 6,000 listed companies. Out of these more than 6,000 companies, you have to select just a few to invest in. When choosing which companies to invest in, is it really right to use absolute evaluation? I have serious doubts about that. So what we need to think about is this. It's not just about whether Apple stock will go up or down in the future, or what Apple will look like. I want to suggest that it might be wiser to approach it by asking, are there any companies better than Apple, instead of just focusing on Apple? Now, in the case of Microsoft, recently there have actually been some issues with their direction in artificial intelligence. What I mean by that is this. Recently, a new artificial intelligence model called Agent has been gaining traction, but Microsoft hasn't really played a leading role in this area. And one very important point is that actually, Amazon, Google, and Microsoft are all great companies, and you could say they're all beneficiaries in the artificial intelligence sector. But if we actually compare the numbers, Microsoft seems to be lagging behind a bit. Let me actually show you some numbers. As you can see here, I'll show you some numbers for 6 companies: Microsoft, Apple, Google, Meta, Amazon, and Nvidia. Let's scroll down and first check their valuations. We're going to compare how much each of these companies is priced at. The most important thing is the PE ratio gap forward. Let me say this again. This is about calculating how many times you have to pay compared to the net profit these companies are expected to generate over the next year in order to buy their stock, and what their market capitalization is. Currently, Microsoft is at 37.7 times, which is very expensive, so its price-earnings ratio has a high valuation exceeding 37 times. In contrast, Apple's is 29.7, which is considerably lower. Looking at the third company, Google, it has dropped to 19.7 times. So we need to think about whether it's better to buy Google at 19 times or to buy Microsoft at 37 times. And another one, in the case of Meta, it's only 27.5 times. So you have to compare whether to buy Meta at 27 times or Microsoft at 37 times. As I mentioned, making a relative evaluation rather than an absolute one can help you make wiser investment decisions. That's what I want to say. Now, if you look here, the one I'm holding, the one I'm investing in, Amazon, is 36.5 times. So it's a bit cheaper than Microsoft, but it's still expensive. Nvidia is even more expensive, going over 41 times. Now, you might wonder why I still invest in Amazon and Nvidia, even though they're as expensive as Microsoft. The reason is that their growth rate is completely different. If you look here, you can see the growth rates, both in terms of revenue growth and, as I've often said, stock price equals earnings times multiple. Since we just looked at the multiples, now we need to look at the earnings, which is earnings per share. Now, let's take a look at how each stock's earnings per share growth rate has been over the past year. So, Microsoft had about 12% earnings growth, while Apple actually had negative growth. So, for this reason, I think Apple doesn't have investment value compared to others. Google's earnings grew by as much as 37%. Meta, right next to it, saw its earnings grow by more than 47%, and as you can see, Amazon is recording an impressive earnings growth of 72.23%. NVIDIA, as we all know, is amazing, with its earnings growing by 81.4%. And this is for the past year, right? So what's more important is how things will be in the coming year. So even if the past growth rate drops a bit, if the company can show healthy growth in the coming year, then the stock price could actually rise even more. But if you look here, Microsoft is only at 16.13% and Apple is just at 8.4%. Now, Apple has become a stock that can no longer grow by more than 10%. And Google is expecting growth of over 20%. Meta is at 24.5%. And Amazon is expected to have an impressive 36.28% earnings growth over the next year. On top of that, Nvidia is expecting growth of over 65%. Now, as you can see, the companies with significantly lower earnings growth compared to the others are Microsoft and Apple. So if you look at the price earnings to growth ratio, by combining this growth trend with the price earnings ratio, you can clearly see a difference in investment value. Now, Microsoft's price earnings to growth is 3.2. As I've mentioned before, if this figure is below 1.0, it can be a really good investment opportunity. And at the very least, if it's below 2.0, we can start to consider its investment value. Apple's figure is 2.79, which is quite high. Google is at a very low, 1.37. Meta is only at 1.88, and Amazon at 2.00, both significantly lower than Microsoft or Apple. Finally, NVIDIA, its price earnings to growth ratio is 1.36, much lower than other stocks. Although its price earnings ratio seemed high, considering the growth rate, NVIDIA is actually the most affordable. That's the conclusion we can reach. So, when I look at it now and make a relative evaluation, compared to stocks like Amazon, Google, and NVIDIA that I'm currently investing in, I can say that, in my personal opinion, the investment value of Microsoft and Apple is relatively lower. Today, I will summarize yesterday's United States stock market performance. First, if you look at the S&P 500 map, at first glance, it's unclear if this trend is upward or downward, but yesterday was a bearish market with a prominent downward trend. However, it's still not that obvious, right? The reason is, as you can see here, the number 1 and 2 companies by market capitalization both went up. On top of that, with companies like Amazon, Google, Meta, Broadcom, and Advanced Micro Devices, all the stocks with larger market caps rising together, it creates the illusion that the overall market was on an upward trend. But if you look closely, there were actually a lot more stocks that went down than those that went up. So in fact, yesterday wasn't really an upward trend. That's the right way to sum it up. If you actually look at the movements of the various indices, the Nasdaq 100 went up, rising by 0.1%. The S&P 500 was flat, but all the other indices were in the red. And if you look at the performance of the 11 sectors of the S&P 500, only 3 sectors went up yesterday. Energy was up 0.71%, technology stocks were up 0.42%, and communication services, which also includes a lot of tech stocks, were up as well. So you can see that it went up by 0.17%. The remaining 8 sectors all showed negative numbers, so you can see that the market breadth narrowed a lot yesterday. Now, there's a reason why only tech stocks surged like this, right? It's because the artificial intelligence beneficiary stocks performed really well. As I explained in detail on yesterday's broadcast, President Trump announced an artificial intelligence action plan. Therefore, you need to hold artificial intelligence beneficiary stocks. And what's been observed is a trend of people regretfully focusing on buying these artificial intelligence beneficiary stocks. That's how you should see it. There's also a phenomenon where investment funds from other stocks are now being moved into artificial intelligence beneficiary stocks. Personally, this is what I think. The breadth of the market has actually narrowed because people are selling other stocks and flocking to artificial intelligence right now. Yesterday, the number of stocks with a good short-term trend actually decreased from 75 to 71 or 3%. And there's almost no change in the long-term trend. It's hovering between 63% and 62%. Next is the fear index. The fear index is 15.33. So we can still observe a very calm state with the Goldilocks scenario continuing for now. The Fear and Greed Index remains elevated at 75, a 1-point increase from yesterday's 74. We've entered the extreme greed phase, but there's no change. Since it's not going up and down sharply, I still don't see this as a negative sign. The most important thing is this. We need to look at how many investors are currently holding cash and how many are holding stocks. As I mentioned on yesterday's broadcast, the percentage of people holding cash is decreasing a bit now, so there's still a chance things could heat up even more soon. If that happens, we'll need to be a bit more cautious then. Anyway, for now, I think it's still a bit too early to sell stocks just by looking at the Fear and Greed Index. It's the same with Market Score. It's been in the greed phase for over 2 or 3 weeks now, but the foundation is there for the greed phase to continue. That means there were so many people outside the market that there are still people coming back in. This is something we need to keep in mind. Next is the performance of Mijun top pick. Compared to the performance of the indices yesterday, Mijun top pick performed much better. The S&P 500 edged up 0.07% while the Nasdaq gained just 0.18%. But what about Mijun top pick? Since most of them are artificial intelligence beneficiaries, the number of stocks that fell was very limited, and some investment funds moved to certain artificial intelligence beneficiary stocks. That's how I see it. At the very top, Kuridu Technology was the best with a plus 2.80%. Second, Advanced Micro Devices was up 2.19%, Broadcom up 1.77%, Nvidia up 1.73%, Amazon up 1.73%, Uber up 1.03%, Alphabet up 1.02%, and B2 rose 0.93%. MicroStrategy rose 0.5%, First Solar 0.53%, TSMC 0.53%, Stratasys 0.44%, Meta 0.17%, Palantir 0.15%, Thailand fell 0.02%, Coinbase 0.28%, Vistra 1.94%, and Bitcoin dropped 2.43% to 115,000. Celestica dropped 2.85%, which was not good. And if you look at the last one, Tesla plunged as much as 8.20%, leading the market's decline. That's how we can sum it up. One of the things I often mention on the broadcast is this, right? I frequently emphasize distinguishing between a correction and a bear market and adjusting your investment strategy accordingly. For investors, a correction isn't something to fear. In fact, we shouldn't be afraid of it, because it comes around almost once a year. And when stock prices drop by about 10% or as much as 18% or 19% like earlier this year, we call that a correction. But there's one thing we need to remember. On average, a correction breaks through its previous high in just 4 months. This time it was even faster. So when stock prices drop by 10%, 15% or 18% like this, it's a correction. Actually, it's not something we should be afraid of, but rather something we should be grateful for. When opportunities like this come, I often say that we should use all the cash we've been holding to pick up stocks at a bargain. But a bear market is a bit different. Bear markets often last for a long time, sometimes even a year or two. On top of that, it can seriously hurt your returns. The market can drop by about 20% or even as much as 35%. That means your portfolio returns could be cut in half or even drop by as much as 70%. Therefore, it's really important for us to notice when this kind of scary, dreadful bear market is approaching. In that sense, there's someone who left a comment here. The username is Jairim. They asked, when we reach the entrance of a bear market, could you let your subscribers know? That's the question they asked. It's also difficult for me to accurately diagnose a bear market. As I've repeatedly said, investing in stocks is about investing while looking toward the future, and there's nothing certain about the future. So what we need to do is consider the probabilities. What are the chances, and how likely is it that a bear market will come in the future? So if this probability is only about 20% or 30%, then we should continue investing. But if this probability rises to 40% or 50%, then we need to be a bit more cautious. In that sense, let's take a look at an article together to see what the probability of a bear market is at this point in time. If you look at the title, it says there's no stagflation. Stagflation is a combination of stagnation and inflation. Stagflation is the worst-case scenario where prices continue to rise during an economic recession, combining the effects of stagnation and inflation. So if stagflation happens, it's a big problem. Now let's take a look through this article to see how likely it is that stagflation, which can be considered a huge disaster, will actually happen. The June employment report provided the latest indicator showing a slowdown in the United States labor market, characterized by steady but moderate job growth. So, what was released in early July was the employment report for June. According to the employment report, job growth is cooling off moderately, and that's not a bad thing. The job market remaining stable is key. However, even though employment is being maintained like this, discussions about stagflation are reaching their peak. As the United States stock market rises, experts anticipate the emergence of stagflation. Because of Trump's tariffs, prices will eventually rise and the economy will stagnate. There are many people making this argument. The outlook that tariffs could trigger another rise in prices is a reasonably valid economic scenario. That's right, tariffs are likely to be passed on to consumers, and if that happens, consumer prices could go up. However, predicting that this is the same as what happened in the 1970s is a mistaken judgment. Why do people mention the 1970s? That's because it was a period when a typical stagflation occurred. Stagflation is a phenomenon where three adverse conditions occur at the same time: high inflation, low or no economic growth, and high unemployment. So prices keep rising, and growth either stops or even turns into negative growth. High unemployment combined with inflation is called stagflation. That's the summary. But here, it is said that inflation and slowing growth are possible this year. This is because of the impact of tariffs. But the important thing is, a high unemployment rate is not seen in the current consensus outlook, and no matter what figures you look at, there is no sign that the unemployment rate will rise right now. And this point is very important. Because a resilient labor market plays a central role in the economy, so if the labor market is strong, the economy will be okay. That's what we can predict. Despite numerous recession warnings after the pandemic, the key factor that has supported the United States economy has been its solid labor market. That's what people are saying right now. Now, another thing about stagflation is that it's not just an undesirable macroeconomic condition. What this means is that for a terrible phenomenon like stagflation to occur, there has to be a policy failure. In other words, it's something that can only happen if the Federal Reserve makes a huge mistake, a really big error. And he also concludes that this doesn't apply to the current situation. Let's read further to understand what he means by stating there hasn't been a policy failure yet. What about the stagflation in the 1970s? An embargo by the Organization of the Petroleum Exporting Countries, occurred alongside the Vietnam War. There was also excessive government spending due to the Great Society program. And it was also the result of a combination of poor monetary policies. Some say that monetary policy was the decisive factor. So as a result, inflation stayed above 5% for almost 10 years, and in 1980 it went up to nearly 15%. But the problem here was the attitude of the Fed. The Fed maintained a very accommodative monetary policy under political pressure from the White House. When inflation hasn't been controlled for such a long time, you shouldn't keep monetary policy loose. They should have taken a tougher stance, but because they didn't, it was ultimately a failure of the Fed. That's how it's being assessed. They weren't prepared to endure immediate pain, and there was also a lack of confidence in the Fed's policy tools. That's why such a terrible thing happened. Today, critics of monetary policy are warning that the United States is on the verge of a recession. They're arguing that the labor market needs to weaken in order to suppress demand and control inflation. But if that situation actually happens, if inflation is controlled as the labor market weakens, then inflation will go down, so the conditions for stagflation wouldn't be met. So they're saying there's no need to worry. In the end, the assessment is that if the labor market weakens, there won't be an inflation problem. And if inflation and unemployment rise at the same time, then that would be a problem. But today's monetary policymakers, that is the Fed, are showing a determined attitude to prevent such a structural catastrophe. The Fed is doing an excellent job. Even as the labor market is gradually cooling, they are taking a cautious approach to easing tightening policies. The labor market is slowly cooling, but the Fed's benchmark interest rate remains unchanged. Jerome Powell is still holding the line, and that's actually a very good job. Looking back at history, the Fed's caution like this is justified. Whether the inflation regime is maintained has a decisive impact on the long-term health of the economy. That's because even if the unemployment rate actually rises, the Fed can't quickly cut interest rates in a situation where inflation is accelerating again. So right now, the Fed is keeping interest rates very high, and that's actually something we should be grateful for. They know very well that if interest rates are lowered too much when inflationary pressure from tariffs arises, it could lead to a spread of inflation. That's why they're maintaining such high interest rates right now to get inflation under control until the end. There's talk about the Fed's dual mandate. There are two goals, as I've always said. One is full employment, and the other is the Fed's dual mandate. As I always mention, the Fed only has two goals. One is full employment, supporting the job market. The second is price stability, but in reality, price stability is a prerequisite for full employment. They're saying that if prices are stable, the job market will also be good. And for price stability, ultimately, it's necessary to stabilize inflation expectations. Currently, the market and consumers believe that inflation will not continue to rise. In fact, inflation expectations are still declining. The Fed's success is the result of decades of effective policy efforts, which is what they are being praised for. So if this situation collapses, that's the real crisis. This situation we're in right now is actually very good. The real crisis is if the Goldilocks situation collapses. Even with high interest rates, it's better for us if the Goldilocks scenario continues steadily. That's how we should view it. If households and companies continue to believe that prices will keep rising, they might demand higher wages, and preemptive price increases will keep happening. Lowering inflation expectations is crucial for controlling prices. That's my point. Fortunately, right now we don't see any warning signs like that, so there's no chance of inflation rising sharply. There's a possibility that economic growth will slow down over the next 1 or 2 years. Due to tariffs, economic growth could gradually slow down. However, despite that, a high unemployment rate is not included in the main forecasts. There isn't anyone predicting that the unemployment rate will rise dramatically. And so far, there's no evidence for that either. The policymakers managed to cool down the overheated economy while also striking a balance so that they didn't sink the economy. The Federal Reserve's efforts have led to the current Goldilocks situation. The time we really need to worry about stagflation is when the independence of the monetary authorities is weakened, or when a Federal Reserve chair who is swayed by the White House comes in, or when the focus on price stability is lost. That's how it's summarized. The stagflation of the 1970s didn't happen overnight. The current situation is due to years of tolerating inflation, which the Federal Reserve is no longer doing. So, I can conclude that it is being managed well. Now let me sum it up in one sentence from Mijun. The main point of this article is this. The key point is that because the current United States labor market is so strong, even if there are some changes in inflation or the unemployment rate in the future, the chances of it leading to severe stagflation like in the 1970s or a deep recession are very low. According to the logic of the article, we can expect that the United States economy is likely to remain in a Goldilocks state right now. That is, an ideal condition that is neither too hot nor too cold. Let me say again, Goldilocks means the economy is growing just enough to avoid a recession, so the Fed doesn't need to make aggressive rate hikes. So, since inflation isn't rising, there's no need to raise interest rates. In fact, you could even say there's a chance they might lower rates instead. Now, this kind of economic environment is generally very positive for the stock market. When the economy grows steadily, companies' sales and profits can increase consistently. Earlier, we examined the impressive growth rates of the Magnet 7 stocks despite the current economic environment. If inflation can just be kept under control, the Fed doesn't need to raise interest rates sharply. Because the economy is gradually slowing down, inflation is actually being brought under control as well. And we can even look forward to additional interest rate cuts to stimulate the economy. If all goes well, we could see 2 rate cuts this year and next. There's a very high chance that the interest rate cut cycle will continue steadily next year as well. So if we have this kind of interest rate cut cycle, liquidity will keep increasing and investor sentiment is very likely to improve. Therefore, at least until 2026, there is no chance that this bear market will come. The bear market that investors fear the most? It usually only happens when at least one of the following conditions is met. The first is an aggressive base interest rate hike cycle. The reason we usually raise interest rates is because of inflation. When the Fed sharply raises rates to control inflation like this, there's a high chance we'll face a terrible bear market, just like we experienced in 2022. Now, the second is this. An economic recession, which we call a recession, when it happens, corporate profits plummet and the unemployment rate rises sharply. When corporate profits plummet, it means this. The probability of stock prices falling is very high. Stock prices are earnings times multiples. When earnings go down, multiples are also likely to decrease. That's why a bear market occurs. The third point is that even if stagflation as described in this article occurs, there is still a high likelihood of a bear market. Now, this article is actually arguing that the possibility of these three worst case scenarios happening is very low, right? Now, of course, this kind of argument, we need to keep in mind that this is based on the premise that the Federal Reserve must firmly maintain price stability and not let the economy fall into a recession. So later, if we, like Jerem asked, if we reach the entrance to a bear market, can you let the subscribers know? I don't know either, but what we need to think about is this. The Fed must maintain price stability. If prices rise sharply, the likelihood of a bear market increases. And we can't let the economy fall into a recession, right? So what about the United States economy? There's a significant risk of sudden negative growth, which could likely trigger another bear market. This is the perspective to maintain. So, periodic corrections of around 10% can happen at any time. A correction usually comes at least once or twice a year, and these corrections can come at any time without warning. That's how you should see it. However, if the fundamentals of the United States economy remain as solid as the analysis in this article suggests, then the probability of a prolonged bear market with a decline of over 20% is relatively very low. The final content for today is the Mijun podcast. Today's main guest on the Mijun podcast is Celestica. If you look at the rankings of returns among the Mijun top picks for 2025 this year, you'll see the trend. Palantir ranks first with a remarkable 104.76% stock price increase this year, followed closely by Celestica. Thank you. In just 7 months this year, it has surged by more than 77%. So, for both our United States, China subscribers, and for me, Celestica is a very appreciated stock. However, there are hardly any articles about Celestica on Palantir B, so there aren't many opportunities to mention Celestica often. But today, for the first time in a while, there's a helpful analysis article that examines the outlook for Celestica's second quarter earnings. I analyzed the content of this article on the United States China podcast, which features both my wife's and my own voice. That's all for today's United States China broadcast. I would like to thank everyone who invested in United States stocks with United States China this week. I hope you all have a relaxing and meaningful time over the upcoming weekend starting tomorrow. Tomorrow's video likely won't be self-filmed. There will be an analysis video by Chief Executive Officer Kim In-jung posted, so I hope many of you will show interest in that video as well. Next week, I'll gather various information that can help with your investment activities and greet you again. Let's continue investing in United States stocks together until we can all retire. Have a happy day, thank you. Hello, Mijun family. Did you start your day with energy? Our kids' vacation finally starts today. Hello?
That's right, everyone. The first day of vacation was hectic. Last night, my oldest played outside until 9 post-meridian. With vacation starting, the kids want to play hard and will be home for a month. Also, the podcast and the United States stock videos might be posted a little late, so I ask for your understanding in advance. With the artificial intelligence boom, the market gets really excited every time related companies announce their earnings.
Yes, everyone, including big tech companies, is eager to uncover hidden beneficiaries.
That's right. So, among the companies that are about to announce their earnings, there's one that could surprise the market again thanks to artificial intelligence. I brought this analysis today because of that. It's
Celestica, ticker symbol CLS.
Celestica. That's the electronics manufacturing services company, right?
Yes, that's right. So today, with this analysis, we're going to dig into whether Celestica really has a high chance of beating market expectations again, what's called an earnings beat, and what the reasons behind that might be.
Then first, we should take another look at last quarter's results. How did it go? Yes.
Q1 results were strong, with revenue growing 20% year-wide to $2.65 billion. And adjusted earnings per share jumped by 39.5%, almost 40%, reaching $1.20. The figures greatly surpassed market expectations. It was really impressive. At that time,
the part that really stood out was the Cloud Connectivity Solutions Connectivity and Cloud Solutions division.
That's right.
Within that, especially HPS, high-performance systems, and networking product sales were tremendous. Compared to last year, it increased by 99%, yes, almost doubled, and its share of total sales jumped up to about 39%. It's amazing. 99% growth, but is there a real reason why this HPS segment is so important? It's not just about generating sales.
That's exactly the point. This segment has much higher sales, so it's a very profitable business. It means the business is not only expanding externally, but also enhancing its profit quality. This point is crucial for enhancing profitability and scaling up in the future.
I see. With such good performance, it's natural that the management would feel more confident. Yes.
That's right. After announcing the first quarter results, they raised the 2025 annual earnings per share guidance to $5, which is higher than before. And for the upcoming second quarter guidance, the midpoint of revenue is about $2.65 billion, which is about 11% growth. They suggested an adjusted earnings per share of about $1.22, but
What's interesting is that according to Wall Street estimates, the revenue is $660 million, and the earnings per share is $1.23. It's almost exactly the same as what the management suggested. Yes.
that's right, it's almost the same.
Even though the first quarter results were such a surprise, it means they didn't really raise the second quarter expectations.
Interestingly, Wall Street's expectations have remained nearly unchanged over the last 3 months. Remarkably, Celestica has surpassed both earnings per share and revenue expectations in all 8 of their earnings reports over the past 2 years. Yes, on average, their earnings per share has come in about 5% to as much as 15% higher than expectations. Shall I continue?
Wow, even though that's been the case all along, it's surprising that this person's outlook hasn't changed. It makes me think they're being a bit conservative right away.
That's possible. Looking at this track record, you could interpret that the current market outlook is a bit too cautious.
Then why is the market being so conservative? Could it be that analysts still aren't fully reflecting this artificial intelligence-related growth trend, especially in HBQS? Yes.
This analysis highlights that very point. It means that the market may currently be underestimating Celestica's role as a key supplier of high-speed networking switches or systems essential for building artificial intelligence clusters. In fact, according to the Union Bank of Switzerland analysis, the artificial intelligence refocused networking market is expected to grow by as much as 4 times by 2029. But already, the HBQS division accounts for almost 40% of Celestica's revenue. The logic is that if they really start to benefit from the growth of this market, earnings per share growth could be much steeper than currently expected.
The growth story is really attractive, but the problem is always the price. Looking at the current PE ratio, it's much higher than the historical average, so I think some people might find it a bit burdensome.
That's right. The current forward PE is over 30, significantly higher than the historical average of around 17, indicating it is definitely high.
Yes, that's almost double, right?
But analysts say that if you consider the artificial intelligence market opportunity, the successful transition to high-margin HBQS, and their position in the market, all these factors justify a multiple above the historical average. Specifically, they think it's reasonable to apply a PE ratio of about 30 times. So from this perspective, the expected earnings per share for 2026 is about $6.13, and based on this, the target stock price is estimated to be around $195.
$195.
Yes, compared to the current stock price, there's roughly a 22% upside potential. That's the calculation, but of course, this is just an estimate based on the current point in time.
Right. Of course, we also have to consider the risk factors. For example, if big tech companies suddenly cut back on artificial intelligence investments, or if their performance doesn't turn out as well as expected, if the justification for the high valuation is shaken, it could have a big impact on the stock price.
That's correct. If the results fall short of even those low expectations in the market, then there could be significant downward pressure on the stock price. Tariffs are also mentioned as a risk, but since the production base is highly diversified and they have the ability to control costs, it's believed that any government can manage this. Yes.
So, to sum up the conclusion of this analysis, there are definitely risks. However, considering the very strong growth momentum in the HPS division and the continuously improving profitability trend, it is highly likely that Celestica will once again surpass the conservative market expectations for this quarter. That's the key point. Therefore, in the upcoming earnings announcement, the most important thing is to check whether the HPS revenue proportion has increased compared to the previous quarter, more than anything else.
If that's confirmed, it will be a very strong signal that this company is really moving in the right direction. That's why the analyst is maintaining a buy recommendation and sees about 22% upside potential.
Yes, I'm really looking forward to the earnings announcement.
And lastly, I'd like to leave you all with something to think about.
Yes, what is it?
What if we look beyond short-term results? Isn't it possible that future artificial intelligence demand will gradually shift from training focused in large-scale data centers like it is now to inference focused on individual devices?
From training to inference.
Yes, if the market changes like that, I think it would be good to consider how well Celestica's HPS product portfolio can respond to such changes. Yes.
That's a very interesting question. I think it's a point worth considering. So, today we looked at various possibilities and points to consider through the analysis of Celestica's quarterly earnings outlook. I hope that what we discussed today will be of some help to you on your investment journey.
Thanks for joining me. Have a great day.
It's important to start with a small dream. Shall we plant a hopeful future together? Growing little by little every day, has excitement blossomed in your heart? Let go of your greed, this time won't be any different. The result is just a continuation of the process. Even if a dark adjustment comes, I'm not afraid. I'll hold Miju's hand and move forward, becoming the light for the unseen tomorrow. See you next week. Let's walk together on this beautiful downhill path. Happy investing with Miju, all of us together until the day we boldly retire with Korean stocks.